Is the market shifting? Stay tuned. Welcome to this week's edition of Note School TV. Well, where every Wednesday at 11:05 Central Time, we bring you the most amazing content as well as the most amazing guests. This week is our monthly favorite. It is our monthly market update. So bring Eddie on in just a minute and we will jump into that. There is a lot going on. So a few things here. Number one, make sure and like this episode. Yep, hit that like button. Make sure and share this with your friends, especially this episode. I've been talking to several people over the last couple of weeks, and by far, you guys, our viewers, want to see what the market is doing, where it's going, how it's shifting, right? From the intro there. So make sure and share this. Also, make sure and subscribe to our Note School TV channel if you have not done so already. And then finally hit the bell notification. Yep, boom, just go ahead and hit that bell notification so that you will be notified when we go live every Wednesday at 11:05 Central Time. If you'd like to know more about what we do at Note School, simply go to noteschool.com/TV and we'll get you set up there. So with that, and with no more pause, right? I want to bring on Note School's founder, our chief visionary officer, my friend, all around good guy, Mr. Eddie Speed.
Good morning, Joe.
Good morning, Eddie. It is bright and shiny here in South Florida. It was 50 degrees last night.
Well, that's pretty cool for you this time of year.
That's
actually
pretty cool. And Eddie, you maybe can share with us kind of at the end of the episode what you've been up to, because you've been really busy. You've been buying inventory for our students, right?
Yeah, the note inventory has drastically shot up. And so the market, because of the market shifting, right? Mm-hmm. It is, I believe, accelerated that variable. And we'll kind of tie that together at the end as to, once we see this data, it'll be easier for me to refer to why that has caused more notes to become available. Right?
Exactly.
It all really kind of ties together. So when Joe, I'll tell you this. When banking is really good, it usually means low note inventory.
That's right.
When banking starts having distresses, it means a lot of inventory.
Yeah.
And so we're sort of an opposite market. And when things are really good and banks are really good, then we tend to do more on the creative finance on real estate side.
Right.
When things are distressing in the market otherwise, then all of a sudden a lot of people show up and need to move their notes, and that's basically exactly where we are. So all right.
Well, let's get into it. Let's get into the market update.
Okay.
So housing market is the first on our agenda, and here's first slide, right? U.S. housing market overview. What is the housing market like right now? Well, Eddie, looks like the median house price is now $420,357, up 4.8% year over year. Looks like number of homes sold are down by almost 10%. And, we'll talk a little bit about this in just a minute when we get to the banking. But no matter what and where we get our data, it's up, right?
You know, it's funny, Joe. Last night, my brother, who is not a real estate investor, but has been around me for a long time and hears me talk about all this, he said, I assume in a presidential year that you are going to have a lot more boom in real estate. And I said, well, that is a theory, but in reality, this year, nothing is really reflecting that. And so I think your correlation there, Joe, that we're seeing, an increase in property values, and we are seeing surprisingly a decrease in number of units sold. is a reflection of the fact that you cannot get around the elephant in the middle of the room. And the elephant in the middle of the room, Joe, is price point and rates.
And you're exactly right. So here we are. So I know that I kind of jumbled this up, but this is in let's see, May of 2022, median home price $432,496. June of 23, $382,729, and currently again it's $420.
Yep,
$357. So that's where we are with housing. With
so a little slide back in value from where we were in 22.
Yes, exactly. A little bit of a slide back, about $12,000. So, yeah, but again, still on that upward trajectory there for sure. 10 metros in the U.S. with the fastest growing sales price. Look at that, and look at that. So, yep, Cleveland is up there on the top of the heap as far as the fastest growing prices in metro. And look, Birmingham's number 2.
Yeah.
So that's what that looks like. And these are courtesy of Redfin. And then we look at housing supply. So with housing supply, Eddie, we've got, let's see, let me let her go in here. Housing supply, we're up a bit. Need to make that yellow. And yep, we're at 1,510,000, which is up about 3.8. Now this is year over year.
Yep.
Look at that. Number of newly listed homes is at 545, which is down just a tad year over year. Number of days on market is 40 days, and that's down just a little bit. And month supply is, look at that, 2 months, but that remains about even, on an even kill there. So bottom line, if we go back over, and let me write a couple of numbers here, and that is that in, let's see, January of 22, there were, sorry about that, guys. Jumping around here on me today. There was 1,106,555. And this was in January of 22, which is kind of, when everything.
These are houses listed, right, Joe?
Houses listed, yep.
Okay.
Today, we're at, we're here, right? Number of houses for sale. So it's gone up just a bit, but again, it's still kind of in that flux situation. So
people say, well, what is normal? Prior to the virus, what is normal? And the answer is 2 million houses.
Yeah.
2 million houses on MLS at one time
was
the norm. It was the standard for many years. And that would have been true right up until the virus started. And then all of a sudden we started seeing this big drop in inventory. And Joe, here is what I'm going to say.
Mm-hmm.
Most conventional thinking is supply and demand controls everything.
Everything.
That's traditional thinking. And I would have told you that in January of 2020. I would have said supply and demand.
Right.
By 2022 and by 2023, I learned that the lack of supply did not outrun affordability.
That's it.
So while we have less houses on the market than normal, we're seeing a flatter than normal real estate market. And that is because that affordability, being price and rates, they trump supply and demand. And Joe, if you'd have told me that 4 years ago, I'd have said that's the craziest thing I've ever heard. Yeah. Yeah, for sure. So we are always learning. This is my 44th year in the business, and we're always learning.
That's for sure. So here's the home buyer payments, Eddie. And see this, up 10.6 year over year. And again, 6.88 is the rate they're quoting there. But as of April 2014, based on the median price home of the 420 and 20% down, we're at $2,775 a month, and that's principal and interest, not taxes and insurance.
So the different colors, orange being the one on top,
right,
are the second one down. That was 2023.
Yep, this
2022 is the red, Yeah, not too much circling there, Joe. We'll get to where we can't see it. Ease up, Tiger.
Oh yeah.
So, but you see that the blue at the top that you circled, you know, went from a payment of about $2,200 to $2,775, right. And so that is, you know, this is just the new world, right?
Yeah.
And so we've really learned that the affordability is really everything. All right, great.
I mean, 10% up that's a big number, right? So Eddie, home buyer stocks or home builder stocks tumble as housing starts fall by 14.7%. And economists say that it is a poor time to buy a house. So Eddie, housing starts in March of 2024, decreased 14.7% to an annualized rate of 1.321. Steepest drop since April of 2020. And you can see those regional drops as well, right?
Very interesting.
Yeah, 36%, 23% in the Midwest, and look out west. So we've got in the West, we've got increased by 7.1%. So yeah, tells a story as to what's going on in the market. And Eddie, I thought this was interesting because this really writes the story for what we talk about here and using creative financing. So this is talking about really, so in 2023, 8% of homes sold in the U.S. exceeded the 500,000. I'm talking about people's personal homes, exceeded the $500,000 capital gains threshold. And that's according to CoreLogic. And then there are a lot of homeowners and sellers that they may owe taxes on excess capital gains above that $500,000 capital gains threshold.
That's not on investment property. That's her personal residence.
That's on personal residence. It was about 150,000 homes that fit that piece in 2023. And so obviously in 1997, here were the thresholds. You had 250 on married couples, 250 or 500 on married couples, 250 on single filers.
Yeah.
Property values have doubled, right? Or tripled.
Yeah.
And so by using seller financing, when they sell their homes, well, we're not saying they don't have to pay that, but they can surely kind of kick that can down the road and pay those taxes as they receive the income, right? Or the payments.
As they receive the price on the house over time.
That's it.
Right. And it could even trigger, depending on their income, it could trigger that they don't meet the threshold before capital gain starts.
Yeah.
So there's another little tax hack in there that is potentially even a far bigger deal. So more to say on that, both with investment property and obviously now on people selling their personal residence that people haven't considered in the past. Joe, people say seller financing doesn't have any tax advantages, and we say wrong, kimosabi.
Wrong, kimosabi, for darn sure. Let's talk about the banks. So this was from National Mortgage News Daily. And Eddie, this really is what the current rate that most people are paying. And that's at 7.44 at this point. And you can see that that's the 1 year from June of 2023 or May of 2023 up through today in April. So, yeah, you can see the different.
This graph does not look as projected.
Yeah.
When we looked at projections, and you can go back and watch Note School TV in December, rates were down to just over 6.5. And it looked like, Joe, that was going to be the deal.
Right. Yeah.
And now all of a sudden they have not done that, but actually they've risen. And so this is something that is affected really the real estate brokerage industry, the residential brokerage industry, as well as the mortgage industry in a way that they were not projecting. They weren't saying it was going to be a banner year, but they weren't going to be saying it was going to be what it is.
Well, Eddie, and they didn't make those projections back, a year ago. These were projections that were made at the end of the year that, we're going to have 3 or 4 rate cuts in just a second, for sure. So this is the APR, Eddie, and we can kind of look there. We've watched this number. You've got your credit scores in the 740 to 759, which is kind of mid-range there, upper prime. And there's what your APR is on a 30-year fixed.
Yep.
So that's what it is. So this is this was Realtor.com. The Fed is poised to hold interest rates steady. Here's what it'll do. So according to Realtor.com economist Danielle Hell, the interest rate is edging back towards 8%. And Mr. Jerome Powell, and I think the Fed meets next Tuesday, Wednesday, we'll need greater confidence that inflation is moving substantially towards 2% before it will be appropriate to ease the policy. And, he's not messing around here. He said the Fed's rates are now at a 23-year high, and policymakers can keep those rates steady as long as needed.
Joe, you and I have many friends that are on the naysayer side of thinking that the Fed is controlled more and more by politics. And the general belief is that's true. And I would say I generally have believed that in times past. But the truth of the matter is, Chairman Powell pretty much seems like he's his own independent guy here. So it could change. With the election's not tomorrow morning, so it could change. But right now, he seems to be carving the path of what he thinks it is, and it isn't necessarily in favor of the sitting president.
Eddie, this brings me back to about this time 2 years ago when we were talking about, and the rate started to go up. And if you'll remember, there was a story that we had there where Chairman Powell said, we have the means, we have the will, and we have the power to move rates where, to get them up as high as we need to take care of. That was 2 years ago.
Yeah.
All right. Eddie, I thought this was interesting. Nearly 50 million Americans are now subprime borrowers forced to take higher interest rates on interest loans, home loans, and credit cards if they can get them. So the subprime category is growing. And here's the thing. I thought this was pretty interesting. Around a third of Americans have prime scores. A prime score is somewhere north. It goes from prime to super prime to, if you get over 800, you're on the real plus side. But experts say that group is shifting for the first time in history in a downward position here. So, it's certainly, that a lot of these folks, Eddie, are not, I think they're penalty box buyers. They're not people that are bad people. They have, their credit may be itching down just a little bit, but what affects that a lot is the debt they have, and people are taking on more debt. It's not that they're not paying their bills, or they can't pay their bills, but it's bad things happening to good people.
No doubt. And we see this in the seller finance world. We call them the penalty box buyer.
Right.
Half of the people that could qualify for a conventional Fanny Freddy type loan today, compared to what the index was at 185. Now it's at, call it 90. And so this is just more reflecting the same. And so this opens up an opportunity for people that would seller finance. And who would I seller finance? Well, they're not bad people, but they're self-employed, or there's some other reason. And so you're not financing the 500 credit score person. You're just seller financing somebody that needs a help just because market underwriting has gotten that tight. So,
and Eddie, this just to make this number, a little bit bigger, is simply this: there's about 146 million people that would be in the market for a home loan. So if you look at 47 million of those falling into this category, that's a third.
Yeah.
That's a third. All right, let's take a look at a commercial multifamily. So the multifamily housing market, well, we know it's declining in 2024. And this is according to the National Association of Home Builders. And multifamily, let me change my color ink there. Sorry about that, guys. Sometimes it is hard to keep up with that thing. Okay. Multifamily starts touched our total 472,000 units in 2023, which was down 14%. Projecting multifamily starts are going to fall 20% throughout the year to a total of 379. And here's the interesting stat here, and that really is that under construction in 2024 is approximately 1 million. It's the highest level since, this is a long time ago, Eddie, 1973.
And Joe, it's like you drive to every city and you see it. I live in Dallas-Fort Worth.
Yeah.
You live in a small town, but you're near Fort Lauderdale and you're near Orlando, so you see it. It's all the projects that were started a year and a half ago that's under construction right now that are totaling this number.
Yeah.
And the reason that they're tapping the brakes on new stuff is because, there is a saturation point that everybody's paying a lot of attention to.
It is. And this kind of this whole piece kind of tells that story. And this is from globalstreet.com. It's another month of negative multifamily rent growth in March. And this is according to the folks that put this data out, apartmentlists.com. Median rent is down 3.5% since its peak in the summer of 2023. And the only period that brought a sharper decline was from September of 2022 to January of 2023. Rents had fallen by 3.7%. So we're down 3.5%, right? And
it's not a dramatic drop in rent.
It's not just crazy.
But it's been sort of a steady fade.
It has. And this is actually,
let me tell you what hasn't gone down. Expenses
have not gone down. Yeah, this was interesting in global capital constraints forced a forced pause, right, Eddie? Yeah. So this forced pause on some multifamily developers and causing others to go back to the drawing board. So they're going in looking for funds to continue these projects or finish these projects or start new projects. And the lenders are saying, whoa, wait just a minute.
Yeah.
And it's just simply the withdrawal of traditional lenders from the market. And just like you said, construction costs way up, workers to skilled workers, of course, taxes, insurance, lower rents, higher vacancy rates, and all of those different things are really, they're just amplifying the difficulty of getting the new markets or the new projects started and up and going and even finished. So, yeah.
So this is what I've noticed, right? And this is 4.5 decades now, because that's how long I've been doing this.
Mm-hmm.
There's two things that related to financing that affects real estate.
Yep.
There's a cost of financing and there's availability of financing.
Yeah.
What I have learned is they're not equal in issues. Cost of financing is dramatic on the market, but availability of financing, meaning who's going to loan the money, that is 10 times the problem of the first one.
Absolutely.
And this is what I've been calling a concern about even on here for over a year. Who's going to loan the money?
Yeah.
And so this is an issue. We know that we saw that the other banks, other than the top 25 banks, we had a stat that said that 44% of all of their assets, all of their loans were in commercial loans, almost 45%.
Right.
And so that's an issue. Whereas compared to the really big banks, it was like 14%.
Yeah.
They don't have much of their play and this is an issue. And I have a friend that that I was talking to about this literally this week, Joe. And I said, the caution flag I have for you is do not bet on something refining in a year, because I'm not sure who's going to be standing up ready to do it.
Right. Who's going to?
I'm not saying there won't be any money, but this concern is what we're watching too.
Yeah.
Right.
That's it.
All of this means, by the way, these strains on the banks, these strains on lenders, is what's also fueling us buying way more discounted notes than we were before. So
Absolutely.
While it's bad for them, and we're not like hoorah in that, but we're the opposite, and we're getting the advantage of it.
That's it. And Eddie, this is not something that's going to be fixed in the next 90 to 120 days with the million units coming, under construction and all of the things that are happening here.
And about 30% of the inventory in the next 18 months, 30% of what's at the banks with maturing loans to be refinanced.
That's it.
And a lot of the banks, and we had an article last month that said that a lot of the banks had kicked the can down the road with modifying loans with extend and pretend. Remember that?
Yep. That was last. Yeah. Actually, it was last week. Yeah. Just kicking the can down the road and saying, okay, well, let's see if it gets better. But it's going to get a little worse, I would think, before it gets better. It'll probably be 18 to 24 months is what we're seeing between in late 25 and then maybe into 26, late 26.
Can I be pessimistic with you?
You can be as clear as you want.
I would eliminate the word little.
Yeah. Yep. Because
the train is coming down the track.
Yeah. Yep. That's for sure. Well, and then article by Fox Business says commercial real estate foreclosures jumped, 117% in March. So you can see the lines here. And this is from our friends that did this at Adam Data Solutions. And let me make that red. And we can see the line there as we go across. And that is simply, it's we're here. And if we look over here, the only time it was higher was in late 2014.
Yeah, and let me just tell you something, Joe. As the banks get not so willing to extend and pretend, and the examiners will have a lot to do with helping them with that decision, that the default rate can jump at a point that would be shocking. And that's my feeling is it's the trains coming down the track.
It can go from 0 to 60 pretty quick.
There's a lot of stuff that is on the books right now that is not technically in default.
Yeah.
But it is absolutely got a big problem. And so that's what I'm paying attention to.
That's what we're seeing. All right. Well, here's the old question we kind of ask this time every week. Are the trees going to the sky, right?
I think a lot of people have. It's not last summer. Last summer, we were still trying to convince our friends in the multifamily world that trees weren't going to grow to the sky, and they got their feelings hurt about it. And some of them did.
Well,
and I think by now that everybody pretty much realizes that we got a different situation. And the question is what does this mean for us? Okay, if you guys are telling me something negative, are you just doing it to be negative, or is there a reason for it?
Right.
And the answer is it's a weather forecast.
That's it.
Pretend like this, Joe. Pretend like this. We sell generators.
Yeah.
There's a hurricane coming.
Yep. Well, let's run through non-performing, and I'm going to let you wrap it up here at the end of this. So I just plugged these in here so people will know that, this was just the other day, April 16th. Fanny Mae announces another reperforming loan sale, which is 6,507 loans. And, when you look at the totality of the number of loans which are out there, we'll get to that in just a second. That's kind of like a drop of water in the desert, so to speak, totaling $1.470 billion in UPB. And then Freddie, just first of this month. Well, actually, the bids were actually due on April 4th, and then on April 25th, which is tomorrow or the next day. These are NPLs, securitizations of reperforming loans, and structured RPL transactions. So these are loans that were defaulted at one time, but now they're reperforming, and you're on top of that as well.
Number one growth for us this year are non-performing loans and reperforming loans. I mean, lights out. We are on this mission. And that is because of inventory.
That's it. This was kind of blaring, and I only put it in here. It's like this big, thing here. This was from our friends at auction.com, where, our buddy Darren Bloomquist is over the forecasting side of this. And he said, is time the enemy of equity for chronically depressed homeowners? And these are homeowners that 475 days, they've been cycling in and out of foreclosure, right? And any equity it goes up, equity comes down a little bit because of the number of days. But this next slide here, I think, kind of tells the story. And this is from Black Knight. And Eddie, this is delinquency and in foreclosure forbearance exits. So if we look up here, of course, this was the foreclosure moratorium, that period of time between, in 2020 and here, and then ended in late 2021. And you see that blue line is the average number of days delinquent. And so we're right in here. And that's 1,000 days, right?
Yeah.
And then we've got the dark orange, which is the in foreclosure exits. And then we've got this delinquent exits over here in the lighter orange. And it just kind of tells the story with this is the exits and this is the number of days delinquent. And you see it went from here. And it was well over 1,600 days in here. And there was, 500 and almost 600,000 loans there. And that was as the foreclosure moratorium went away. And then you had people were falling out, not because they could fix, the loan was all fixed, everything was taken care of. It's because their foreclosure or the forbearance ended, right?
Joe, if I've ever seen one single slide that paints a really clear picture, it must be this one.
Yeah.
The gray part shows when you couldn't foreclose.
Yep.
So why did days delinquent go up? The blue line. Look at the beginning of the gray, and it shoots way up. Okay. That's because nobody could be foreclosed on. So obviously a loan that was in default, the number of days delinquent goes up.
Mm-hmm.
We've seen it slide back down a little bit, and it's at 1,000 days now versus 1,600 days. And then all of a sudden you see this defaulted number. And really, Joe, if you look over there, it's just not moving much.
No.
Meaning that we've not gotten rid of the problem.
That's it.
And this year is the year that everybody says the problem is going to come to the head. Yep. And that's what the mortgage banks and the trade desk that I deal with, that's the word. It's coming to a head. All of this is because of accounting, right? And the accounting says the lender has now charged down these loans, and that's the day that they start liquidating them and selling them in the secondary market. The lenders are not going to foreclose themselves, although they're probably going to start the foreclosure. But they can afford to sell the loans at a pretty deep discount because they've had them on the books forever, and accounting-wise, they've charged them down. So they're not on the books at the full face amount of the note. They've been charged down. And that's how the industry really works.
That's it. And Eddie, we're not, we're talking about, from what is that, May of 2020 to February of 2024, when these numbers are actually, it was March of 2024 when these numbers just came out. But I mean, we're not talking about this huge period of time that all this happened. A lot has happened in the last few years, and now it's time to get it worked out, right?
That's really a good chart right there, Joe. Congratulations. I mean, if you're trying to find one chart that paints a picture of what we've been describing, that's really good. So awesome.
Very good. So when we look at the biggest and the latest, the total number of delinquent loans, it's approximately this. It's we know it's more than this. You got to throw in the home equity conversion mortgages and things. So we're well over 2 million. But this is the latest from ICE. And Eddie, there's that 1,000+ days that we just talked about.
Yeah. So you can see, like when we say we're down to 1,000 days delinquent, when you look at the chart and you realize we
you look at that, right?
100 days delinquent at the peak of it in July of 21, then we're going down. But as you can see, the fade on that blue line, it's not going down at a very high pace. So,
and Eddie, again, when we look at it really, and that's, that was in 5 of 23. So we're not seeing this huge drop from 5 of 23 to 5 of 24. It's just that's that fade, just like you said there. So,
so let's summarize it and talk about the cycles. I love what you're doing here, Joe, right? Yeah. Because it's what works in what market. And I started doing this in 1980. Mm-hmm. Right. And what happened in the 80s and how the 90s worked in the early 2000s up through 2008. And then after the crash that started in 2008 and on into the 2010 cycle, and what was happening crazy in 2020 and how different that is, Joe, just 4 years later. Right.
Yeah.
And so let's look at where we are. The opportunity to sell or finance your property today versus renting it is the best that I've seen in at least a decade and maybe way past that, right? Because, Joe, you can rent your house for, say, $1,600, but the mortgage payment on that same house with a non-QM loan, Joe, instead of $1,600, this is rent, this is your mortgage payment, it goes up to about $2,300 on the same house. And that's just the market. If I own or finance, I'm not a landlord. I don't have taxes and insurance. On the rental side, 50% of the money I collect in rent goes out the door in expenses. Remember, expenses on a rent house have gone up 65%.
That's right.
Right? So I net, Joe, on that $1,600 rent. Now, this is over a period of years, not a period of the end of every month necessarily. But the gold standard in real estate is you get to keep about 50% of your rent. So that means I keep $800.
Right.
Joe, if I own or finance, I get a payment of $2,300. And I got no expenses except the loan servicer. It's about $30 a month.
That's it.
So the gap in financing is crazy. And so that's why you sell or finance today versus rent, right? And we have most any landlord that we are seeing, and a lot of them are showing up at Note School today saying, show me more. Tell me more. I want to see how this works.
Yes.
So we've gotten really used to doing this math, and we can make it really simple and easy when somebody comes and comes down the road with us because we run this math all the time. And I'm on podcasts and interviews like every week, almost every day, like talking about this. This has become the thing that people are talking about. Everybody says, bill rentals, do this and do that. And what do you do when the market's against you? Well, building rentals in 2016 is not the same as building rentals in 2024. It's just not the same math.
Yeah.
And so some people are enamored with rentals, but very few people would ever argue that my math is bad. And I'm not saying there's not an opportunity. It just opportunities change, timing changes, circumstances change. The next thing is discounted buying notes. So, Joe, in 2021, there was a shortage of notes. Interest rates were crazy low, and there just wasn't availability of notes. And so when you're looking at this, buying discounted notes has drastically increased. Joe, I can tell you that literally since a quarter back, call that December, January of December of 23, January of 24, compared to where we are right now, we're bidding on 5 times the amount of discounted loans we're bidding on. I can tell you that with 1,000% integrity. People say the market can't move that fast. I'm just telling you. Joe, was I able to help you a lot with this presentation and preparation? Because what was I do? We were working
out buying notes,
making deals on discounted notes.
Yep.
So this is, and people say, well, why is that true? The reason that is true is because the banks are under pressure for either them or their clients to liquidate discounted notes to clean up their balance sheet. It's just math. And that is exactly where we're at. And am I fired up? I'm fired up.
Fired up. That's it.
But understand that as I look at these years and these cycles, we've been a lot of different things in a lot of different situations, but the non-performing loans and the reperforming loans, as well as seller financing, that is, let me just say, it's keeping this old cowboy kind of busy.
It is. And, Eddie and I, we talk when we can, but he's really out there. He's swinging the bat. We say visionary, our chief visionary officer. That's what Eddie's doing. And that's what he excels. He excels at that, and that stirring the market and finding that. And Eddie, every piece of this, from the market, from the housing market to the banks, to what's happening in commercial and multifamily, to non-performing loans, that's just led us to this perfect storm with everything that's going on out there. It just is what it is, right? I mean, it's our time.
The value in seller financing today is a very different proposition because the expense of money and the availability of money has gone way down. The expense has gone way up. The availability has gone way down, and it's just not the same market. And so we call them the penalty box buyer, and that does not mean that they're bad in any way. They don't have bad credit. It's not some chronic deal where they can't pay their bills. No. It's just they've been left behind, and we have an opportunity to do it. So that creates inventory of notes, and also creates opportunity for people that might consider seller financing. So, Joe, I want to compliment you. You really put all this slide deck together because I really am busy buying notes.
Yep.
And I want to just say that, buddy, you nailed it. This I thought was excellent. This whole balance of these slides and the stuff that you did to kind of pull the story up to give us a clarity to the market. I'm proud and honored to co-teach with you any day of the week, sir.
Absolutely. And Eddie, this is really, the last 3-day class we did, what you had told me was that people just really want to know what's going on in the market. And I was doing a call midday on Monday with some of our newer students, and they said, we just want to know what's going on in the market and where we're going and what we should be looking to. And I thought this was totally appropriate. Spent a lot of time looking and digging into this, and I thought it came out really, really, really well today.
Excellent job.
Guys, that is it. We appreciate you. We will see you same time, next week, 11:05 Central Time, noteschool.com/TV as well. And we'll have a guest next week, and we'll get right back into the rhythm, and have a great rest of your week, and we'll see you next Wednesday. Bye now.